Good afternoon. This is Michael Kimmel, and I'm happy to welcome the almost 270 registrants to RPB's Summer 2020 installment of our quarterly webinar series. I do hope that everyone is healthy and otherwise doing well through these unprecedented times we're facing. All of us here at the RPB, thank goodness, are healthy and otherwise doing well with working from home. In addition to myself and Len Teitelbaum, Chair of the Board, joining us today are David Baskin, who is Chair of our Investment Committee and President and Founder of Baskin Wealth Management, Ross Bremen, Partner with NEPC, RPB's outside investment consultant, and Stephanie Berger, RPB's Director of Marketing and Communications. Now, before I turn it over to Len, who will review the agenda and provide opening remarks, a few items. I would like to stress to those of you who have not yet logged on to your Fidelity Net Benefits account to please do so. The best way to protect your account from unauthorized access is to set up your user ID, password, security questions, and to turn on two-factor authentications. Once this is complete, at least for the first time, nobody will be able to log in if they otherwise had your birth date and social security number and then begin to transact as if it were you. Additionally, if you call the Fidelity Retirement Service Center, you can set up an additional security measure where Fidelity will record your voice and use that voice print as a means to verify your identity on future calls. You can do this by calling Fidelity at 800-343-0860. This number can also be found on the My RPB for Participants login page, accessed from RPB's website. Again, you can access it through just by going onto our website and going onto My RPB for Participants, and that Fidelity Service Center number will be there. Now, for the webinar, as always, it is being recorded and will be posted to our website in a few days. We will also email a link to you. Regarding questions, thanks to those who submitted them in advance. We will address them at the end of the session, as well as those submitted during the session, which you can do by simply clicking on the Q&A button found at the bottom of the screen. This can be done anytime throughout the presentation. Now, Len, the floor is all yours.
Thank you very much, and good day to you all from truly our houses to your house. Now, before we get into the investment area of our webinar, I want to sincerely say that I hope you're all staying safe and are keeping well and sane in these absolutely incredible times. Let me try to assure and ensure you that with all the trials and mishigash with which you are trying to cope, the RPB is functioning well, and from what I have seen, is not missing a beat. I'm repeating what Michael said. I think it's important to repeat it. Now, the senior staff of Michael, Alice, Robert, Stephanie, and Maria are steadfast to their duties and responsibilities. Their office phones ring at their homes. They seem never to take breaks, and singularly and collectively deserve all our thanks, and I do so now. Michael and Stephanie especially, you've done a remarkable job so far, and it's been tough, but quite frankly, I think our participants are benefiting greatly because of your efforts. Now, I've also written to each non-senior staff member, offering them not only thanks for the job they've done, but are continuously doing. We all remain dedicated to our mission of assisting and providing you with a dignified retirement and trying as best we can to financially protect your future. With that said, let me just quickly review the agenda that you see on the screen. I'll be turning the microphone over to our principal speakers, and they will go through the second half outlook, how to manage investment risk, and of course, as Michael said, Q&A. So with that, please let me turn the communicating device, whatever it's called, over to David and Ross. Gentlemen, please.
Thanks very much, Len, and welcome everybody. As Len pointed out, this is certainly the most unusual quarter probably that most of us have experienced. The COVID epidemic, which has swept the world and which is still wreaking havoc, particularly in the United States, is something that none of us have ever really had to cope with before, since the last epidemic of this significance was not during any of our lifetimes. So we have to consider how we should be positioning our investments and what we should be doing to ensure that the value of your investments is preserved and that we don't suffer any lasting damage going forward. Tomorrow, we're going to see the report on American gross domestic product, which will likely show the most significant drop since the Second World War. Gross domestic product, of course, is a flow. It gives you an idea of how much economic activity is going on. And we know that economic activity dropped drastically during the second quarter, as virtually every business sector was shut down to one extent or another. We also know that, wisely or unwisely, a lot of economic activity has started up again in the third quarter. So we're going to be watching very carefully to see what we can glean from that. We're also aware that much of what's gone on has been affected by governmental policy, both on the monetary end in the United States by the Federal Reserve Bank, and on the fiscal end, in which governments have provided income support to their citizens by way of various stimulus programs. I wonder if we could change the slide, please. So what's going on right now, and in fact, the Federal Reserve is going to report, I think, in 8 minutes from now, we expect no change in the Federal Reserve policy of keeping interest rates at essentially zero. That is to say, the most accommodative possible financial and fiscal or financial policy. In addition to keeping short-term rates low, the Federal Reserve is aggressively buying assets on all kinds of markets, including corporate bonds and commercial mortgages and commercial paper, in order to keep interest rates low across the board. This has been unbelievably successful to the extent that we see companies able to raise funds for 10 years for less than 2%, and we see the government able to raise funds for 10 years at less than 1%. These are certainly shockingly low interest rates. And while this has been very supportive of the business environment and certainly makes it easier for the government and for companies to service their debts, it also was worth remembering that for savers and pensioners looking to have interest on their investments, this is certainly a situation in which they feel the other side of the sword. They are getting less interest on their investments and certainly can't look forward to any change in that interest rate environment, certainly in the midterm. So we know that interest rates are going to be unrewarding for quite some time. Could I have the next slide, please? It's going to surprise probably a lot of people. It certainly surprised us how strong the stock market was in the second quarter. In February and March, at the end of the first quarter, we saw an absolutely devastating downdraft in the market, a shocking reduction in values, which saw the S&P 500 and the Dow Jones Industrials fall up to 40%. And these drops were echoed around the world. But what we saw in the second quarter, perhaps surprisingly, was a very sharp rebound, bringing equity values almost to where they were at the start of the year, modest declines only. And in the case of the high-tech stocks, which dominate the NASDAQ industry, we saw a record high in the NASDAQ in July. In other words, stocks like Apple and Google and Amazon rose to all-time highs in spite of the economic conditions. The gold market is setting all-time highs as we speak. Oil has rebounded from essentially a price of zero hit in March, and even things like real estate investment trusts have come back somewhat. So we've really seen a remarkable rebound after the devastation of the second quarter. And at the end of the first half, as we'll see later on in this presentation, things are not, if not back to normal, they're back to something resembling normal. And really, those who hold a diversified group of assets are not in as bad shape as one might have predicted when looking at the results at the end of March. Next slide, please. As I've noted, interest rates have fallen to record lows across the board. This has resulted in returns that have been very good if you happen to own bonds with a long maturity, and mediocre returns for most other kind of income portfolios. There's certainly been defaults on corporate bonds that are high risk, so-called junk bonds. And most investment managers, of course, want to steer away from those companies that are vulnerable. And we've seen, for example, in the department store industry, hundreds of $millions of defaults on bonds as names that we all know, like Brooks Brothers and JCPenney, disappear from the scene. The federal government has been adding liquidity for small businesses and municipalities in order to ensure that they're able to survive this moment. Next slide. In the equity sector, the story has mostly been about technology. The giant technology companies that we all know and which dominate the NASDAQ have risen in value to previously unseen heights. We have trillion-dollar valuations for Amazon, for Microsoft, and for Apple, never before seen. And as you can see, for the year to date, the column on the right, circled in green, the technology sector is actually up 15.7% for the year, something that we couldn't have imagined at the end of March. And the only other two sectors that are in the black, healthcare and consumer discretionary goods, up slightly. All other sectors are in the red, with energy leading the way on the downside, and that's understandable. So again, a diversified portfolio has served participants well because nobody could have guessed exactly which sectors were going to do well and which ones weren't during this period. Next slide. We always like to present this asset quilt to talk about what's doing well and what's not doing well. If you look on the far right-hand column, you'll see the multicolored assets show you what's done well and what's done not so well for the year. Alerian MLP Master Limited Partnerships, by far the worst asset class following oil down. The best asset class, bonds, because this includes long bonds that have gone up in value as interest rates have fallen. But as you can see in that column on the right, aside from long bonds, nothing else has really made money in the first half of the year. I'm now going to turn it over to Ross to amplify and add to my comments, and then we're going to talk about the actual performance in the first half of the year for the RPB.
So David, this is actually Michael. I just heard from Ross, who apparently got disconnected. This is one of the, I guess, the challenges with all of us working from home. He somehow got disconnected from the call, and so maybe if you want to keep going, and I can also chime in on how we've been doing on our investments.
Okay, thank you, Michael. I want to get paid double for today. So this is a snapshot of our Tier 1, our managed products for the first half of the year. The Capital Appreciation Fund, which is the most aggressive of our products, the one that has the most volatility, obviously, and is primarily involved with equities, is down 7.6% for the year. Again, compared to the first quarter, it's a remarkable improvement from where we were on March 31st. and somewhat below the benchmark at 7.1%. I think there's a number of reasons for that. One of them is a product which we think of as very safe, but which has performed very badly in this quarter, and that is a value product which concentrates on dividend-paying stocks. One of the most interesting and perhaps perplexing aspects of the second quarter performance was that things like utility companies, telephone companies, pipelines, and banks, solid dividend-paying companies, blue chips, as we think of them, underperformed the market rather markedly and underperformed technology stocks by a country mile. And because we have a value orientation, which we think of as being oriented towards capital preservation, it did not serve us well in the current quarter, and in fact led to that underperformance. Personally, I believe that value stocks will have a comeback. They will have their day, although of course one never knows when. But that's why capital appreciation shows that gap against its benchmark. The second column is the 1-year return, slightly positive. Again, that's probably a surprise for most people when we think of what was happening in the first quarter. The 5-year, which were dead on the benchmark, and inception to date, slightly trailing the benchmark over an extended period. Next slide, please.
David, Ross is back now, so if he can take over.
Okay, Ross, I don't know if you were able to hear that or not, but you can take appreciation and income.
Oh no, we lost him again.
Okay.
I guess he's having some computer troubles.
All
right, so why don't you keep going?
My fees are going up by the minute, Michael. Okay, our second product is our blended product appreciation and income fund, which is an agglomeration of the capital appreciation fund and the income fund. As with the capital appreciation fund, we're trailing our benchmark somewhat. Some of the same reasons apply. The income fund has an equity component which is meant to goose the return in these times of very low interest rates, but the kinds of stocks in there, the value stocks, are exactly the ones that I described as being out of value, or sorry, out of favor when I was talking about the capital appreciation fund. And as a result, for the first 6 months of the year, we're not only underwater, but also underwater against our benchmark. For the year over year, the 12 months ending June 30th, the results are positive, I'm happy to say, at 3.6%. Again, slightly below the benchmark. 5 years, nice return, a little below the benchmark, and on inception to date, almost exactly on the benchmark. So appreciation and income, less aggressive product, obviously not as a lower return as the capital appreciation. Next one. So income focused, which we normally think of as a fund dedicated to preservation of capital, which we don't expect to make very much money, has in fact been the big winner of the first 6 months of the year. The reason for this is simple. As interest rates go down, the market value of bonds goes up. And the longer duration of the bond, the longer that it has until maturity, the more its value goes up. So a 30-year bond for the first 6 months of the year might be up as much as 15%, whereas a 3-year bond might be up only 4 or 5 or 2%. You can see that the income focused fund is in fact positive for the first 6 months of the year, is positive for the year over year at 6.7%, and also positive for the 5 years and from inception to date. As interest rates continue very low, the boost that the bond market got from the fall of interest rates and from the massive intervention by the Federal Reserve Bank will tend to bleed away, and we're going to see returns on the income focused fund probably in the low single digits, I would guess, for the next year or two. And our final managed product If we can get the next slide. I'm sorry, we're not showing that. So we're showing volatility. Volatility is a measure of risk. It tells you how much the value of your investments change during the period, and obviously the lower that is, the less risky the strategy. You can see that our capital appreciation fund is considerably less risky than our benchmark. And as I told you, our value kinds of stocks focused on capital preservation have less risk than, for example, the technology stocks that have done so well in the first half of the year. And it's a trade-off for all investors. If you're prepared to accept high volatility, you may have quarters like this one in which technology outperformed everything else by a wide margin, but you will also get quarters in which technology and similar highly volatile sectors underperform by a whole lot. So we have always chosen the less volatile, less risky route, and you can see that that's where we were. The appreciation and income fund, almost exactly as volatile as its index. The standard deviation is almost identical. And the income focused fund, somewhat less risky than the aggregate, which means that the duration of our bonds, the length to maturity of our bonds, is less than that of the benchmark. One of the reasons that we didn't go up quite so high as interest rates fell back. Next slide, please. Tier 2 is our do-it-yourself, if you wish, segment of the pension plan, in which you, the participants, get to choose exactly what assets you'd like to hold. You can see in this case, almost all the asset classes to the left of center are negative. And this is what one would expect in the context of a falling market. The first one is the S&P 500, which is negative around 3%. The next is the small cap index fund, a more risky product, more volatile, and pointedly in this case, does not include the very large technology companies. And as you can see, the results there, double-digit losses for the half year. The developed markets index, which has a large non-US component, down double digits. It turns out that markets outside the US did not do very well in the first half of the year. It's a conscious diversification strategy on behalf of the RPB to hold non-American assets, recognizing that the American market is now less than half of the world stock market. It turns out that in the first half of COVID, owning non-US assets was not a great strategy. The next, the Vanguard Emerging Markets Index Fund, like everything outside the United States, didn't have a great half, and emerging markets are generally considered to be a pretty risky asset class with a high standard deviation. And finally, the asset class which did the most poorly were the real estate investment trusts. Now, real estate investment trusts are generally bought because the cash on cash income is pretty high. But with tenants of all kinds defaulting on their rent, residential tenants, commercial tenants, and industrial tenants, the ability of landlords, including the landlords included in this index, to collect rent and make their buildings pay became doubtful. And that's why that was the worst performing asset class on the chart. The four asset classes immediately to the right of center are all fixed income classes of various kinds. The Vanguard Total Bond Index, up a lot because it includes long duration bonds. The Vanguard TIPS Index, the inflation protected index. I have to tell you, nobody is very worried about inflation right now, and that asset class did not perform particularly well. The Vanguard Short-Term Bond Index, up 4%, which is pretty good for short bonds. And finally, our Capital Preservation Fund, a managed product which has the lowest possible risk, 1%, because it's in very short duration instruments that are protected by insurance. So that's sort of a solid, nothing bad can happen. Next slide, please. A product which we introduced a little while ago and which is gaining increasing following with you and your fellow participants is our Jewish Values Fund. This fund is designed to track the S&P 500 more or less. I'm sorry, to track the world index more or less, but with alterations made to decrease emphasis on assets which don't represent Jewish values. So very light on oil, weapons, things like that. And as a result, the weighting in things like technology by default goes up. So the reason that the Jewish Values Fund beat its benchmark by almost 2% is simply because there's a relative overweight in technology, which was the best asset class in the first half, and a relative underweight in energy, which was the worst asset class during that 6-month period. We don't expect that the Jewish Values Fund will have such a wide divergence from its benchmark normally, but as we know, these are not normal times. For the 1-year period, again, very positive versus a benchmark, and since inception, also positive against the benchmark. Next, please. So this is the section. Yes.
Hi, David. Sorry to interrupt you. Ross seems to be back online. And,
all right. I'm happy to cede to Ross for the outlook.
Okay. All right, Ross. The floor is all yours. Ross.
Thanks, Michael.
Here you are.
Thanks,
Okay.
David. So if we can have the next slide, please.
You're up. It's up.
Great. So David has talked a lot about the markets in the first half of this year, and as he commented, the second quarter was largely up, but it certainly wasn't everything that was up. Depending on which asset classes you were invested in, you might have still seen some negative numbers, and so I think the question now is, what do we expect on a go-forward basis? And given everything that David said about COVID-19 and the support of the markets from the Federal Reserve and stimulus packages from the folks in Washington, those two items, those two areas are by far the most, or we expect will be the most impactful factors on a go-forward basis. The virus trajectory, whether we get a series of drugs to help us in the virus battle, will be a key determinant. Whether the country can remain open and the economy can continue to pick up, those are very important factors. I think from a permanent intervention perspective, we expect the Fed to continue to keep interest rates very low. And right now, Congress is debating another $1 trillion stimulus package. And so we expect, at least for a while, the government to replace what would otherwise be consumer spending. So I think that we expect that on a go-forward basis, the virus will continue to be the big story. We obviously don't know what's going to happen, in terms of whether it will be resolved or whether it will continue for several more quarters. Hopefully, hopefully we'll make some strides with regard to treating the virus and protecting against the virus. And then we expect the government to continue to be involved in assisting the markets. I think some of the secondary themes continue to be out there. Before COVID, we were seeing a lot of questions about the interactions of different countries. We saw the Brexit circumstance as we moved towards COVID and into COVID. We saw the trade war with China. I think that we'll continue to see a lot of conflict or potential conflict, if you will, to the extent that the different nations, as they struggle with low growth rates, and now the COVID situation, I think there will continue to be some conflict. And then growth, what will happen as its growth continues at a significant rate, perhaps.
Sorry, guys, I think we might have lost Ross again. I'm gonna move on to the next slide, and maybe we'll ask David,
Michael, I'm back.
Oh, you are
Can you
back,
hear me?
okay.
Yeah, can you hear me? Sorry, that.
Yeah.
Okay. Next slide, please.
We'll keep things moving along here.
Yeah, so just real quickly, you can see here some of the stimulus numbers. We expect it to continue, and it can support higher price levels than we would otherwise see. Again, that's the combination of low interest rates and stimulus. Next slide, please. Yeah, I think we don't know exactly what the recovery is going to look like. Some folks have probably read that there can be different shaped recoveries. There's the V-shaped recovery. There's the L-shape. There's the W. Hopefully the recovery from COVID and the economy will be quick, but we don't really know. We could see some fits and starts, which would be more like a W. But these are all sort of unknowns, if you will, as we move forward. Next slide, please. And so I think, given these circumstances, these questions, what are the things that we're thinking about as we go from here? Next slide, please. Are these truly unprecedented times, or will we have a return to usual, to normal? Obviously, we've talked about the pandemic. We've talked about the volatility as a result. We think that low interest rates are here to stay, but to the extent that we're going to continue to get news about the vaccines and how quickly things come about, I think we'll continue to see the volatility in the markets. We do have the election coming up, and so people are probably wondering what impact that will have. I would say that in the short term, we may get a lot of volatility as a result of the election. Long term, the ultimate behavior of the markets will be driven by fundamentals and earnings. And so from the long-term perspective, while recession and the market environment might have some impact in terms of who ultimately wins, from a long-term perspective, the ultimate performance of the markets and earnings will ultimately decide, how financial assets perform. And with that, I will turn it back to David to talk about how participants can manage risk during this period.
Thanks very much, Russ. So we're well aware that when the markets are like this, people get nervous, and it's entirely rational. I mean, nobody likes to see their lifetime earnings and savings dissipated, certainly at the rate that we did in the first quarter of 2020. We recognize, and I think all of you on the call know, that different asset classes have different levels of risk and volatility associated with them. If you choose to put your money into guaranteed certificates of deposit or into our very low risk product, there's almost no risk, but very little return and very little prospect of higher returns. If you buy bonds, particularly bonds of a longer maturity, as we saw during the second quarter, there is a possibility of higher returns. And if you buy things such as real estate or stock, you get more volatility and accordingly more potential return. But you shouldn't interpret the blue line on this graph as being a certainty. Merely taking more risk does not guarantee more return. All it guarantees is that sometimes you'll have more return and sometimes you'll have less return. On average, you'll end up on the blue line, but certainly not in any one period, and maybe not even in a fairly lengthy period of 2 or 3 years. You can certainly take more risk and underperform, and that's exactly what risk means. So what does this mean on a practical standpoint about what you should actually do? Number one, remember that because this is a participant-driven plan, this is a contribution plan, it's up to you, each participant, to educate yourselves to ensure that you're paying attention to your pension and that you're making the decisions that are right for you. So that what I'm going to say now is in a general kind of way, not investment advice, or not advice about what to invest in, but kind of overview advice. Number one, recognize that emotional decisions are rarely good decisions. And I say this as somebody who's dealing with 850 families, for most of whom we have all of their investable money in the world. And I have 150 families who depend on me every month to send them money to put food on their table and pay their rent. So I'm well aware that as one gets older and one's financial situation might become more precarious, it's very scary when the markets are volatile, and particularly when we see values go down as they did in the first quarter of this year. But I tell my clients all the time, and I'm telling everyone listening on the call today, that making a decision driven by fear of loss, a decision driven by reading the headlines on social media or on TV is rarely the best way to invest. A longer term approach, even if you're in your 80s, is much wiser than taking decisions driven by short-term emotions. For that reason, it's very important that you think about your retirement and you update your plan annually. Many of the participants on the call and many of the participants in the plan will have a working spouse who will have assets of her own or his own, and perhaps a pension of his own or her own, which should be taken into the plan. It's important to plan holistically as a family so that everybody has both a part in the decision making and understands what part they play in the family plan. Asset allocation, as between stocks and bonds, has to be done with a view to your tolerance for risk, because making yourself miserable and not sleeping at night is not a good long-term strategy. But it also has to be done in recognition of what your investment plan calls for. If you need 5% a year to to retire the way you want to, you're not going to get there owning certificates of deposit. But if you need 3% a year and you hate risk, then maybe you shouldn't own a lot of stocks. And otherwise, it's not one size fits all. You have to determine what is right for your family and what you should own. Realigning your portfolio, rebalancing, is one of the hardest things for people to do. It turns out that both rationally and as it turned out in the event, practically speaking, people who looked at their portfolio at the end of the March and said, I'm now underweight in equities because they went down in value, and went out and bought more equities, probably the hardest thing from an emotional standpoint that you could possibly do, did the right thing. At least annually, you should look at your portfolio and make sure that the assets that you own are in alignment with your goals. one of the interesting things about time horizons is how they've become extended over the last 30 years when I've been in this business. When I started doing this in the early 1990s, we expected people to retire at 65 and reach the end of their lives in the mid to late 80s. We now see many of our clients working into their 70s and living well into their 90s. As our time horizons extend, we have to make sure that our plan recognizes that our asset allocation recognizes this, and that we have to balance our need to preserve spending power with our need to preserve assets. It's a balancing act, and it can only be done by paying attention. Finally, in terms of preparing for times like this, I don't know how many of the participants on this call or participants in the plan have been forced into involuntary furlough or have had their salaries reduced because their employers or congregations are in financial distress. It's always wise to have some liquidity on hand just in case that situation comes up. And that being said, I'm going to turn this over to Stephanie, who's going to talk about our provider Fidelity and the resources available to you to do the things I've just talked about.
Great, thank you, David. So there are a number of resources available from Fidelity, our new record-keeping services provider, that can help you manage your retirement account. And we want to briefly highlight those for you today, and those will help you with the concepts that David just outlined. First, you can set up an appointment with a Fidelity retirement planner to answer your investing questions and get advice about your asset allocation. The 800 number to set up that appointment is there on the screen, and it's also available on our RPB website. Next, there are 4 features on the Fidelity Net Benefits website that you want to be familiar with. And as Michael said earlier, if you haven't logged into Fidelity Net Benefits yet, that's something that you want to make sure you do as soon as possible so you can take advantage of these. So the first one is, as you can see on the right, there's a pie chart that says asset classes above it. So you'll see on your homepage a snapshot of the asset classes you're invested in and in what proportion. So this is under the balance on the Net Benefits homepage, and it's basically showing you how well diversified you are within your RPB account. The next feature we want to call your attention to is the account rebalancing feature in Net Benefits. Again, this relates to the point that David made about keeping your portfolio aligned with your objectives. You want to rebalance your RPB account because market movements may cause your holdings to shift from your desired asset allocation, and you may end up having more or less risk than you actually realize. The rebalancing feature only applies to how your current contributions are invested. From the homepage of Net Benefits, you choose Change Investments, and then, as you can see in this chart underneath the text, you're going to select the item called Exchange Multiple Investments. And this is where you can change the current percentage of your balance that's invested in each of your funds to a desired percentage. So for example, if your desired percentage is 70% in the Capital Appreciation Fund and 30% in the Income Focused Fund, but due to market movements, it's now 80% in Capital Appreciation and 20% in Income Focused. It's through the Exchange Multiple Investments function that you can move that back to 70-30. Now, the next thing you want to keep in mind about rebalancing is that after you actually enter that information, you're then presented with 2 options. The system can automatically continue to rebalance your account for you on a regular basis, either annually, quarterly, or semi-annually. Or you can request that you be sent an email from Fidelity to let you know when your current allocation slips from your target allocation by either 5, 10, or 15%. So the next feature we want to bring your attention to is the Planning and Guidance Center. This is accessible from a link at the top of the Net Benefits homepage, and it's where you set up your financial goals. An incredible feature here is Fidelity's retirement score. And you can see on the right, this person's in the red, so their score is 60. Right now, they're falling short of the money they will need in their retirement. So this, again, is a personalized function. You also get a printout of a retirement plan, something you yourself would print out. And your retirement score includes what your hypothetical retirement income would be. There are other financial and life goals that you can explore in the Planning and Guidance Center as well. The next feature we want to call your attention to is a planning tool called Full View. This is available from the library, which is a link at the top of the homepage in Net Benefits, and it's under the Calculators and Tools section. So Full View lets you monitor your entire financial life and get a detailed view of your total net worth. You can include your and your partner's investment accounts, retirement accounts, and credit card accounts. You may be asking yourself, why would I want to put all that information onto this website? And what is important for you to know is that it's a completely secure function and only you can see that data. So if, for example, you entered a credit card into Full View and you linked it to your credit card account, that balance will show. So you will constantly be reminded of how much you are or are not spending and how to budget to make sure you have enough money to pay off that credit card balance. So again, you can access Full View from the Tools and Calculators link in the library. The next thing we want to remind you of is the provisions in the CARES Act that are available to retirement account holders that have been adversely affected by COVID-19. If you're under 59 and a half, you can take a special distribution of up to $100,000 without incurring a tax penalty for an early withdrawal. If you have a loan from your 403B account, you can put those loan payments on hold. And if you want to take a loan for the first time, you can take out up to $100,000 or 100% of your balance. Previously, this was $50,000 or 50% of your balance. For those of you who are receiving required minimum distributions from your 403B account, the 2020 RMD will not be distributed. If this is something that you still want to take, you'll then need to call Fidelity. And the number for the Fidelity Service Center to take advantage of any of these CARES Act provisions is here on the screen. So lastly, we just want to let you know, RPB and Fidelity is here to help you with any of your questions. Robert Perry and his team are at RPB. The number is listed on the screen. And again, for Fidelity, there are two different numbers. The retirement planners are to set up an account to go through your retirement planning investment questions. And the Fidelity Service Center is for help with logging into the Net Benefits website and any of the features and functions that you want to use there. And now we're going to go to our questions and answers. Before we go there, I just want to remind everyone on the call that we will be sending you the recording for this webinar as well as the slides, and it will also be posted on our website. So I'm going to turn it over to Len to go through some of the pre-submitted questions, and then we will turn to the questions that are being submitted while we're on the webinar.
Stephanie, thank you. And really thank you again for trying to orchestrate this and trying to keep us all in line. And again, I think it's to all our benefits to have you on staff and getting the job done as you have. I'm going to start with a couple of questions here that number one, is the market high and ready for a correction? Ross, why don't you start? And David, if you have anything to say except duck, please go ahead. Ross?
Thanks, Len. So I think that it's understandable that folks would believe that the market is high, given where we are with the COVID situation and the economy not growing significantly at this point. But I do think you have to remember that the stimulus packages and the Fed keeping interest rates at zero has, along with a lot of positive news around a potential vaccine for COVID-19, has really supported a lot of optimism. And so the current stock prices really reflect that optimism. And I think that's why we're seeing stock prices where they are today. And we know that markets can be overvalued for long periods of time, and they can be undervalued for long periods of time. So, I can certainly understand why somebody would feel the market is overvalued today. Although having said that, there's nothing that suggests that it can't continue in this way for quite some time.
David, next question wants to know, and regarding, I will call it your arrow chart. What % of investments should be higher risk and what should be low risk? I think gets to your point of what are your goals and keep them monitored. David, would you have a response to that question, please?
Well, I think it's entirely individual, and I think it's a big mistake to try and pound square pegs into round holes on this question. Number one, in my estimation, is understand what you can tolerate in terms of risk, because the theoretical asset allocation that Fidelity or anybody else might generate for you, mechanically saying, a 60-year-old professional earning this much money, should have, 71% in equities, might not accord with your psychological predispositions. There are some people who would wake up in the middle of the night in a cold sweat if they had 70% in equities. On the other hand, there are some who would say, I think I should have 85% in equities because I don't mind the risk. So number one, understand your risk tolerance. Number two, on a theoretical basis, as we get older, normally we should reduce the amount in the more risky assets and increase the amount in the less volatile assets. But as we get older is a tricky phrase at a time when many of us are going to live into our 90s. So imagining 20 years of retirement, which I think is realistic for most of the people in the RPB, is a much different proposition than imagining 10 years of retirement, which was the case, for example, with the generation of RPB participants before you. And basically, if one gets too conservative too soon, the results will be disappointing. So I know that that's not a specific asset, or specific answer, but I think those two things need to be balanced, understanding your risk tolerance, but understanding that you need to take a certain amount of risk to get where you want to end up.
I think you may have answered this next question with that, David, because somebody would write in, despite individual situations, when do rabbis, and here a rabbi, aged between 70 and 85, switch from mostly medium risk investments to low risk?
Yeah, so I think I kind of addressed that, but even a 75-year-old rabbi could be looking at a 20-year time horizon. And I say this having just spent the day yesterday with my father, a retired rabbi who's 100 years and 6 months old.
Mazel tov. I'm already retired, writes one individual, and drawing from pension. What could or should I do to ensure a more secure retirement in today's economy? Already drawing from their pension.
Ross, why don't you take that one?
I didn't hear it clearly. Can you just repeat it real quickly? Thank you.
Writes in, I'm already retired and drawing from my pension. What could I do to ensure a more secure retirement in today's economy?
Sure. So I think that's one that's similar to some of the other themes that have been mentioned throughout this call, that people have to be sort of true to their circumstances and honest about their risk level. And so if you're already drawing from your pension and you're concerned about where the markets might go from here, you might also have an income focus. I don't know. That might suggest a risk posture that is not 100% equity. It might be something considerably more conservative. So I think that you have to figure out what your circumstances are, and the fact that you're drawing on the pension. Does that mean that you're in retirement, significantly in retirement, and you need to be more conservative? Maybe it could mean that you're that it's maybe the pension is a small percent of your overall assets, and it could let you take more risk with other assets. So I think it's just again, you have to evaluate what your circumstances are and figure out what your risk profile should be, and there, as Stephanie said, tools and services to help you do that via the RPB program.
And I'm glad you reminded everybody of that, because I don't think we can do so enough. There are now tools that we did not have before that would help you answer some of these questions in your individual circumstance. There are a couple of questions that are both related to those who are nearing retirement. And let's assume they're within a couple of years of when they think they're going to retire. And is that the time to start making changes, even though the market environment is so volatile? David?
Well, I think it should be ideally an annual process. Everybody should be looking at their plan at least once a year and paying attention to it. For most of the participants, this is going to be, if not their largest assets, probably their second largest asset after their principal residence. It requires you to pay attention to it, and everybody should be paying attention, if not all the time, at least once a year, and making adjustments.
When I started in this business, which was in the late 60s, I can assure you that the pension plan their pension was almost their largest investment ahead of their house. Then, of course, real estate caught up, et cetera. But the point being is these are very, very large percent of assets. And I think some of the tools that David and Stephanie and Ross are alluding to do help balance, at least in your mind, how you should look at these assets. A question has come in about why is such a heavy foreign stock in the RPB A&I for accumulated appreciation and income portfolio? Why such a heavy foreign stock investment? Ross?
Yeah, I think so. The group is used to seeing the quilt chart, and we included it again in this presentation as well. And the purpose of the quilt chart, it reinforces that year to year, period to period, there is never a single asset class that is at the top of the list, every period. And when you think about non-U.S. stocks versus U.S. stocks versus bonds, high quality bonds versus low quality bonds, these are all different asset classes that when you put them together, you can have a diversified portfolio, that helps you weather the storm. Putting together asset classes that are not perfectly correlated, some are going up, some are going down, and things switch over time. And so to the extent that the appreciation and income portfolio, it is by definition a balanced portfolio that has both stocks and bonds, and then it's diversified within those sub components. The stocks are made up of U.S. stocks and non-U.S. stocks. At the end of the day, the non-U.S. allocation that's referenced in the question, it's an effort to diversify and reduce risk over the long term, regardless of anything that might be happening, today or tomorrow.
Len, let me jump in real quick. Hi, everyone. It's Michael again. It's 3 o'clock, which theoretically brings us to the end of our webinar today, but we're going to keep going. We have a fair number of questions that have come in, and we want to be able to try to address them all. We totally understand if you need to leave to make your next appointment, but we're going to keep going. But just know if you have to drop off, that this webinar, the full webinar with all the Q&A, will be available on our website within a few days.
Michael, why don't you take over and read the questions that have come in that you can see and I can't?
Okay, I'm gonna start with that. So a question for Ross. How are the benchmarks established for the RPB funds?
So the benchmarks are identified in the investment policy statement that the investment committee uses as its roadmap, if you will, when thinking about the different funds that are offered. Benchmarks are typically every manager has a benchmark. Every asset class has a benchmark. Typically, we're trying to match the benchmark with the kind of the investment area, that we're trying to get exposure to. So, for example, the Capital Appreciation Fund is an equity offering, and it has a growth orientation. It also has domestic stocks and non-U.S. stocks. So in that case, MSCI ACWI is the benchmark. MSCI ACWI is a mix of domestic and non-U.S. stocks, and it includes stocks in emerging markets as well. So at the end of the day, we're trying to match up the benchmark with the market exposure that we're trying to provide, and the funds are managed in a way such that the performance is going to be something similar to the benchmark. In the case of appreciation and income, for example, that's a mix of stocks and bonds, and so there we have kind of a slightly different dynamic to the extent that we're trying to have a long-term balanced market exposure. And so in that case, we actually have a strategic kind of a long-term 60% stocks, 40% bond objective that's a balanced portfolio to mitigate risk of being invested fully in equities or fixed income. And so that portfolio also reflects that balanced objective. The portfolio itself is effectively over the long term about 55 to 60% stocks and 40% bonds. So the short answer is we're picking benchmarks that represent the different asset class categories, and they're all well-known benchmarks. We're not picking any sort of esoteric benchmarks that people have maybe never heard of.
Great, thank you. David, we have a question. If I'm invested in the Income Focus Fund and want to rebalance to take more risk, do you do that after the market has a correction?
So market timing is one of the most tricky things there is. We never know when the market is going to go up and when it's going to go down. And if somebody had asked me on the 1st of April, do you think that the S&P 500 will go up 20% in the second quarter, I would have said, don't be absurd. Of course it won't. And I would have been 100% wrong. But equally, if somebody had asked me on the 1st of January, do you think the S&P 500 will be down 40% in the first quarter, I would have said, don't be absurd. Of course it won't. And I would have been equally wrong. Nobody knows when the market's going to go up and when the market's going to go down. And just because it has corrected doesn't mean it won't go down more. And just because it's in the middle of a rally doesn't mean it won't go up more. So I recognize that's an unsatisfactory answer. But if one were in the income focused fund and was seeking more risk, one way to do that might be over time. In other words, perhaps every quarter move 5% of your allocation from income focused to capital appreciation, and do that for a number of quarters in a row until your risk appetite has been satisfied. Sometimes you'll buy at the right time, sometimes you'll buy at the wrong time, but know that there is nobody in this business who can time the market with any accuracy.
Great, thank you. Next is a question for Michael. Why do you show returns without taking into account the management fees? I would like to know what the actual returns are for our investments.
Thank you, Stephanie. Well, actually, the investment returns are shown net of investment management fees. So the slides we presented earlier and all the information we ever publish on our investment returns on our website are always net of the investment management fee.
Great, thank you so much. For Ross, since experts have called for the last few years for the end of the bond bull market, where might we be in the near term?
Sure. Yeah, it's a good question. I think obviously with interest rates so low, the question is, will they continue to be low? Could we see them increase a little bit? And right now, they're certainly based on economic growth. There are really no sources of inflation that would automatically lead to interest rates rising significantly in the near term. But I think that folks have to remember that there has been a lot of money pumped into the system from the stimulus packages and the Fed action providing liquidity to the bond market. So with that being the case, if we were to have the economy really take off, if we get a vaccine, et cetera, things could change and we could see some inflation. So in the near term, I don't know that it's likely that that we're going to see dramatic change, but I think circumstances could change rapidly, depending on what happens with the
We might have lost Ross.
Stephanie, why don't we move on to the next question and Ross can come back in when he gets reconnected.
Sure, great. So for David, is there an argument in favor of pulling assets out of the market, going liquid, or at least half, since the economy could collapse?
So I think the answer to that is very much in line with the answer to the previous question, which is that we don't know how to time the market. Could the economy collapse? Well, I suppose that if the U.S. Congress decided to end all stimulus programs tomorrow, and the Fed said, we've done enough and we can't do any more, then you could risk collapse. But I don't know if that's going to happen. Nobody does. And if you do, you don't know when it's going to happen, and you don't know when Congress would relent and bring back the stimulus. So timing is very tricky. I can tell you this as an anecdote. We have about 850 families that we work with. During the course of the last 6 months, 18 of those families have decided to go in whole or in part into cash. So that's about 2% of our client base. Of those 18, 15% recognize that they made an error and have come back into the market. We get asked this question multiple times every week, and our answer is always the same. We can't time the market. We don't think anybody can time the market.
Great, thank you, David. For Michael, the next question is, where can I find which stocks and bonds are in my portfolio?
So right now we don't have an easy, we don't publish that information, but on request, and actually takes us, believe it or not, a little bit of time to pull it together, we can pull together a list of the individual securities that are within our various investments. As a reminder, we don't pick stocks, right? The RPBs, only with our managed products, our tier one managed products, do we pick the underlying managers, which each manager represents their own asset class. It's up to that manager to go pick the stocks. And that's only when those managers are actively managed. A fair proportion of our investments are actually, for example, with the S&P 500 Vanguard Fund, which is the S&P 500. So, but I wanted everyone to understand that we do have access to that information. It does take us a little bit of time. For the individual who requested that, send me an email separately and we can work on pulling that together for you.
Great, thank you. Michael, there was also a question that came in about required minimum distributions, that they will not automatically be sent. Can you just reiterate that point?
Yes. So as part of the CARES Act, the IRS is not requiring required minimum distributions to be taken this year. So for those of you who are on a regular, are retired and taking a regular monthly distribution, nothing changes. And those distributions will continue whether or not they historically met your RMD. For those of you, and it's a small, I believe it's a small proportion of you who receive a single payment from us, usually in the November, early December timeframe, that represents your RMD for the whole year, that payment will not happen unless you contact Fidelity and say, yes, I do want this payment. And you can let them know how much you want. All distributions are now going to be, are being processed through Fidelity directly. You don't have to come to the RPB. But specifically for the RMD, the default is we're not going to send it, or Fidelity won't send it unless you otherwise instruct them to.
Great, thank you. There's another question. This is related to how our plan works. If a rabbi passes away, can the spouse remain in the plan?
Yes, always spousal beneficiaries can remain in the plan for their life. We will set up a new account in their name. It'll be set up as a beneficiary account. The one thing, though, that is one of the couple of things that is different between a spousal beneficiary account versus a rabbi's account is the spouse is not able to continue to claim parsonage on their distributions. Parsonage goes away once the rabbi passes away. But like I said, the spouse can keep the money in the plan for their lifetime. Non-spousal beneficiaries, there are rules that require the money to be distributed within a certain amount of time. That information is actually on our website.
Thank you, Michael. And a few more coming your way. One question, is RPB or Fidelity managing the plan's funds?
So RPB is still the plan sponsor. RPB is managing the funds, the investments that we presented earlier. Nothing really changed from before, other than instead of accessing your account on Alaris's website, you're now accessing your account on Fidelity's website. That is, at its core, the major change that happened back in April. So while you may recognize Fidelity out there, they're a brand name, we see them on TV all the time, we are still managing the funds and still working very closely with all of you throughout your time with RPB.
Thank you. And two last questions. This one is for Ross or David. The news suggests that the possibility of a contested election. How might investments be shifted to prepare for this eventuality with a retirement date in the next 5 to 6 years?
I'm going to leave that to the American on the call.
The American got kicked out again.
Yeah.
All right. So in that case, I will, at the risk of being an uneducated Canadian, take a stab at it. Look, I think in the event, God willing, that the Democrats win both the White House and the Senate, we would certainly expect to see some rollback of tax cuts, which might be perceived as negative for stock markets. I would, however, say that if one looks at the records of the stock markets under Democratic regimes versus Republican regimes, the Democratic presidents have better stock market returns. I would also say that taking a longer view of the American economy, the most dangerous thing in the American economy is the maldistribution of wealth and income, and any steps taken to ameliorate that are in the long run very beneficial for the stock market.
Great, thank you, David. One last question for Michael, and anyone else who has submitted a question that we didn't get to, we will reach out to you via email. This question is, will you plan to keep a New York office after the pandemic or continue to work from home?
So we will keep our office, and we have 8 years left on a lease, so the office isn't going anywhere. But once it's safe to return to the office, we will. I'm personally in no rush, nor is any of my staff. We're working effectively, but it's not optimal. As many of you may know from your own experience in having to work from home, you know, the one thing we miss each other and our physical presence, and two, we miss the collaboration that is often lost by not being physically together, at least sometimes. So while we're going to continue to work from home, the New York office will hopefully open up again, and we will resume regular operations there when it's safe to do so.
Okay, that's it for our Q&A. Thank everyone for who stayed on the call for being with us. Michael, is there anything else that you want to add?
I don't think so. I think some of the other questions that have come in we'll try to address directly with the individuals, and those that make sense to post, we'll share those. We'll share those online.
Great. So thank you, everyone, and enjoy the rest of your day.
Thank you, everyone. Take care.
Thank you.
Bye-bye.